Hey everybody, it's Brian with your Mortgage Insider update for this week. I've got a little bit of a different studio in today. Hopefully this video finds you well. I have an update on markets and just a personal update. I can still be found at brian@thecushingteam.com. That's where you received my email with our weekly newsletter. We'll always be there, but we are going to be housed on our new mortgage loan applications with Essex Mortgage as of this week. So very exciting news. Let's dive right in and show you what's happening in the marketplace after the CPI report. Down, red is bad. We have a lock alert this morning after the CPI report came out. As expected, inflation did come down slightly, but not to the level that the markets are looking for. We see mortgage-backed securities are starting to bring the prices down. They're selling off. We have the U.S. Treasury bonds, which is probably the best simple way to view the markets, and the 10-year Treasury. You can see the last number of weeks has actually been up. We saw a high back on December 28th, and we've really taken advantage of middle of January and early February until the jobs report came out, which really outlined that the Federal Reserve's probably not going to stop raising their short-term interest rate anytime in the very near future. We're likely to see them raise at least another 0.25%, and that became super evident after 500,000 people plus went back to work in the month of January, according to the Bureau of Labor Statistics. So we've seen that bounce back up. We can see the CPI report today. We started off actually a little bit lower. Things have kind of settled down. Generally speaking, S&P 500 has not tracked super well, but they've hit a high just recently. Came back down. Same thing this morning. The gyrations in the markets for all different types of assets is really being seen with traders trying to figure out what direction the Fed's going to take. Mortgage-backed securities that work now. This would be the reverse of the interest rate. This is the price to the security. Prices falling means interest rates are up. So we're seeing interest rates at a level right around the first of the year in early January, right the second, after coming off of really good rates just in the last couple weeks. So we'll start to see more about that. Okay, so the CPI report coming out, and 0.1% reduction on the core and the headline inflation. So that's just a minor move, right? So year over year, just a small reduction. We still have a couple more months of relatively high inflation numbers in the fives. On the core CPI at about 5.6% right now. The Federal Reserve is really looking to make their impact with interest rates by raising their short-term interest rate, the overnight rate, to most recently 4.75%. As they raise that even further, they'll get to 5 and maybe a little bit over 5 in the coming months, while the CPI report and even the PCE report, that's another inflation figure that the Fed does come in and review, those numbers will start to come down below the rate of the federal funds rate. That's when we'll finally see a turnaround on interest rates. Still not hugely impactful right now, still over 6% generally. We'll see how the cookie crumbles in the next couple months. I think by May we'll start to see much better numbers, but for this week, make it a great one.